This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Larry Swedroe. Larry is a Buckingham Asset Management principal. He's authored or co-authored, I believe, 14 books. Prolific. He comes at investing in his writings at ETF.com and his books from an evidence-based approach. I enjoyed our conversation. We both come at this from slightly different vantage points. But I think there's some commonality in our thinking. The evidence-based thinking. When we talk about momentum style trading in this conversation, we are really not talking about trend following as I write about in my books and as I talk about in my podcast. It's a slightly different perspective. I do hope you enjoy this conversation. I enjoy talking to Larry quite a bit. I wanted to jump in with this idea of forecasters, and you had a great piece on your site on your blog entry. I know it goes to a lot of different places. I think it was on the ETF.com where I caught it. But the idea of wizards and forecasters and people constantly talking about how they can predict tomorrow. Why don't you just, as we kind of ease into this subject, because I know I can get deep with you, but as we ease into this subject, why don't you give me your thoughts about prediction and the idea that the forecasters out there think they can tell the investors what's going to happen tomorrow? We should all know this is impossible, but people pay a lot of money and watch a lot of TV thinking it's possible every day.
Yeah, Mike. Well, this is a very interesting question with lots of aspects to it. So the first thing I will say, it certainly is possible to forecast the future. You can do that sort of by, reading astrology blogs or whatever. On occasion, they get it right. It doesn't mean there was any skill behind it. The question is, are you more likely to get it right than if you are, if you will, by throwing darts at the wall? And the answer there, we happen to know, is that there are no good forecasters. So there are two books that I would recommend people read if they're interested in what I would call the science here. The first is by a fellow named William Sheridan. Sheridan was an economist who was called to testify in front of Congress on the outlook for inflation. He was an expert in this area, and he got the brilliant idea that he ought to check the forecasting records of the people who had gone before him. And he went and did that. And he found that the forecasting track records on the experts on inflation were no better than, if you will, the proverbial dart throwers or looking at the current yield curve. And then he got the idea, if these experts couldn't forecast something, like inflation, then, maybe he ought to look into other areas. And he did a whole study on all kinds of economic forecasts and market forecasts. And he published his findings in a book called The Fortune Sellers. And he found that basically there are no good forecasters. And that includes even people who have some influence over the outcome, people such as economists at the Federal Reserve who can tighten or raise interest rates to slow the economy and dampen inflation, or vice versa. There are economists who had no better track records than assuming that inflation in this latest period would be the same the next period. The second and even more compelling study was the first scientific study, I think, really of forecasts, and that's done in a book called Expert Political Judgment by Philip Tetlock. And Tetlock looked at things that are far more important, I think we can all agree, than whether you get the economic forecast or inflation or stock market forecast right. But things like, will Khrushchev launch a nuclear attack if we blockade Cuba? does Saddam Hussein have weapons of mass destruction? And he studied, I think it was 7 major categories: medicine, science, economics, etc. And he found that in no areas were there any good forecasters, really. And the problem is, and this is my experience, I'm a trained economist, sold economic forecasts for major institution, one of the largest in the world, ran trading rooms, acted as an economist for major organizations. And what I've learned really is that despite the evidence, there's just an all too human need for us to believe that there's somebody out there who can protect us from bad things happening. Especially when there's bad news, people pay attention. They want to believe that there's someone out there who has these great insights. Unfortunately, here's what I have come to believe based on my own experience and the evidence. First of all, there's only 3 types of forecasters. Those who don't know where the market's going. The second type is those who know they don't know. And the third and most prevalent kind are the ones you see on CNBC or read in Fortune magazine. They're the ones who know they don't know, but get paid a lot of money to pretend that they do. Which is why whenever I'm asked about my forecast, and I always have an opinion, but I never pay attention to it because I've learned better, is that unfortunately, there's only one person who knows where the market's going. And if I ask them in this lifetime, I won't get an answer. And in the next one, it won't matter anyway.
Let me just do a quick follow-up. You don't have to expand much, but for the tuned in listener, they hear you say CNBC and pretend. That's pretty strong. I mean, you said it in a nice way, but it's pretty strong when you really think about it that many of the people that you do see on TV, I'm not saying you, but just the audience in general, really needs to understand that these folks are pretending. They just don't know, regardless of how confident or assertive or compelling they might sound, or how pretty or how handsome or how great that Rolex looks on their hand. They just don't know.
It's even worse than that, because some of them, I believe, know they don't know. And they're just charlatans. They're getting paid a lot of money to pretend. Some of them probably believe that they have special insights, but the evidence shows that that just isn't true. The problem is for people, one, we have this need to believe. Second problem is that we have, as human beings, we're subject to massive confirmation bias. So, for example, if you're a Democrat, a liberal Democrat, and we're maybe worried about inflation or the economy, and you have a Democratic president, and you have some forecaster come along, and they're going to predict bad things are going to happen, the odds are very good you'll totally ignore them. On the other hand, if you're a Republican, and you have that same forecaster make the same arguments, you're now much more likely to believe them, even though there's no evidence for it. And it turns out, of course, the reverse would be true. If you're a Republican and there's a Republican administration and you get someone forecasting bad things about the economy, you're more likely to ignore it. So it turns out, as investors, we're actually much better investors when the party we favor is in power, because we tend to be buy and hold. And when the party that we favor is out of power, we're much worse investors. We get bad results because we tend to listen to these forecasters when they make a statement like, oh, the Obama administration's blowing the debt through the roof and inflation's going to go, way up. So we're much more likely to believe that and sell in 2009 and 10 and 11, and we miss out on the great rally.
Fair point. I'm going to jump around on you because you cover a lot of territory in your writing. One of the things I wanted to jump into is a little bit of compare and contrast the value perspective perhaps to the momentum perspective. And I've seen you write recently why some anomalies persist. And you talk about momentum as one of them. And I wonder for the audience out there, like some people in my audience, they know my work and whatnot, but I'd love for you to kind of give your explanation about momentum And this anomaly, which really it goes against the idea of the efficient market hypothesis. So I wonder if you could kind of expand on the anomaly of momentum and perhaps your thoughts.
Yeah, so let's start off by understanding that riskier assets in theory should provide higher expected returns, but that doesn't mean guaranteed returns. And no matter what your horizon is, you might expect to get an equity risk premium, means stocks will provide higher returns than, say, treasury bills, but there should be no guarantee in your mind. It's just that the longer the horizon you have, the greater the odds are that that will happen. But it's never 100%. And in fact, investing is always about uncertainty versus risk, where risk is like at the roulette wheel or the crap table, where we know exactly what the odds of something happening. With uncertainty, you can't know the odds. So sometimes we can have things that approximate risk, like the odds, Michael, that you'll die in the next 10 years. We don't know it exactly, but we have mortality tables. But there could be a world war, and an influenza that spreads around the globe that's non-predictable, earthquakes, things like that could throw the data off. But you have pretty good confidence in those estimates. When we're talking about investing, the best we could do is to understand that we may have an estimate of the odds of something happening based on historical evidence, but we should admit we don't know the odds. So that's important to understand. Second thing then is, so we have risk and expected return is related. So now you have things like most people believe, of course, stocks are riskier than bonds, so we should expect stocks to outperform. Small stocks riskier than large stocks. And while there's a big debate among financial economists whether value stocks are riskier or not, the traditional finance school believes that value stocks are riskier for a variety of reasons, like they have higher volatility of earnings, they tend to have more leverage, they have more what's called irreversible capital. You can't just turn an automobile plant off tomorrow if your capacity is big and you get a recession, where if you're providing a service, you can lay off people and your expenses go down dramatically. There are some people who believe that it's more of a behavioral phenomenon, meaning that people overestimate the ability of growth stocks to grow earnings as quickly enough to justify them, and therefore value stocks get undervalued and growth stocks get overvalued. Now, with momentum, there really is no good risk story, I believe. But the evidence is that momentum actually is as persistent as the equity premium is, if not more so, no matter what periods we look at, 5-year, 10-year horizons, whatever. Momentum is just as persistent as the stock premium, and it's just as large. And we have this anomaly because there's no risk explanation. In other words, stocks that have outperformed in the last year, relative, and it's always relative, not up or down, but the best performing, say 30% of stocks in the last year, will continue to outperform the 30% of stocks that have performed the worst in the last year, and that on average continues for about 5 months. Or so. Now that's what's called a fast-acting signal because it doesn't last long, and then you tend to get mean reversion. On the other hand, the equity risk premium and value and size premium are longer lasting. You need longer time periods to be sure that that's going to happen. The problem is, if a stock outperforms in the last year, you now have to believe all of a sudden it's more risky. From a company perspective, are their earnings now going to be more risky? Has the company got more leverage and more subject to a financial crisis? There's got to be some financial reason to make it more risky, and the answer is there isn't any. And yet, that evidence is there, so it's an anomaly. The only thing that I think you could point to as a logical explanation is that human beings can't stop this behavior. They tend to buy what is done well recently, thinking you can extrapolate the past, or at least the recent past, and they jump on the bandwagon, and whether that's an individual stock, asset class, money manager, and they tend to avoid or sell off things that have performed poorly fairly quickly. So that's the problem that we have there. There's no risk story. And I'll just throw one other explanation for why it happens, which is that when stocks are going down or the market's going down, you have people who are on margin. They get forced to sell with the margin call. That puts more selling pressure. You also have people who took too much risk and their stomachs scream, "Get me out," and they sell, and that drives prices lower, and you get more margin calls and more people who reach this GMO point where your stomach screams, "Gets me out." So you get this tendency, but there's no good risk story for this to happen. Economists call it an anomaly. Why does it persist? Well, if you have undervalued stocks and you have overvalued stocks, then what should happen is the arbitrageurs would come in and buy the undervalued stocks, pushing them up and making them less undervalued, and they would go short the undervalued stocks and drive their price and then sell them, driving their prices down, and the anomaly would disappear. That's what tends to happen when you have what are called no or very small frictions, meaning there aren't a lot of trading costs to executing it. And the problem is that, especially with small stocks, there can be high trading costs, and in order to go short a stock, you have to borrow it, and that means your losses are unlimited, and people are afraid of shorting, not only because of the unlimited losses, because you can have to put up more and more margin. So you have these what are called limits to arbitrage that prevent these hedge funds or other sophisticated investors from eliminating anomalies. I know it's a bit of a long explanation, but I think it helps people understand the problem.
Let me throw it out to you this way. So from your perspective, could you ever favor for clients, in your writings and bringing up the conversation, could you ever favor in talking to investors about the low cost, low leverage, transparent liquid alternative, like something like a diversified trend following or momentum? Is that ever in your mind a part of investors' portfolio?
Well, let me answer it this way, Michael. I believe that the winning investment strategy, and I've written about this in my 14 books now, is that you should make decisions that are not based on your opinions, but they're based on what I call the science of investing or evidence-based investing. So we have this very strong and persistent evidence that there is a momentum premium. And it exists not only in stocks, but in interest rates and currencies and commodities. However, it is a high turnover strategy, so you want to be careful about probably avoiding it in taxable accounts because it's going to be very tax inefficient. And you might want to think twice about dealing with it in terms of the smaller stocks or less liquid markets, because your trading costs can be very high. If you're going to invest in a fund of any type, you want to make sure the manager has the freedom to be a patient trader, so they're not forced to trade because some signal came out. So you have to be very careful about it, especially in small caps. I worry less about it in larger cap stocks. So that's also an issue as well. And lastly, to me, if I have persistent evidence and it's pervasive around the globe with out-of-sample tests, so that gives me more confidence that the data is right, and then I have a risk explanation, I'm willing to call it a heavy bet on that continuing or persisting in the future. So that's why I invest in stocks, and I have a strong tilt in my portfolio to small and value stocks, because the evidence is both persistent and pervasive there, and the turnover rates are relatively low for passively managed funds. With momentum, I'd be a little bit more careful because there is no risk story, while there is risk stories on the others. I wouldn't ignore the evidence, but I want to be much more careful. I'd make a smaller bet, if you will. The funds I personally recommend all include screening out for negative momentum. By that I mean they will not buy a stock, even if it was a large stock that fell and now is a small stock, or a growth stock that fell and now falls into their buy range because their price earnings or price to book ratio is low enough. But now I won't buy it if the stock is exhibiting negative momentum, because that's what the research shows. I'm better off just delaying a buy I would have made anyway. And conversely, if it's a value stock going up and it leaves my buy range, I might not sell it for a while until it stops exhibiting the positive momentum. Again, it just delays a trade that I would otherwise make. So by incorporating these screens, you actually are getting some of the benefits of momentum without the negatives of the high turnover and some of the tax inefficiencies that can get there. So that's one way to incorporate the momentum strategy. And there you have none of the shorting issues and the risk of, huge losses as well. However, there are some funds. MTUM is a momentum, based strategy. I think that's worth looking at. But again, I caution people to keep it in the most liquid parts of the market because of the high trading costs. I also invest personally in AQR style premium fund, and one of the four categories is this momentum, but it's diversified across asset classes, not just stocks. And it's just one of four premiums that they're going. So I'm making a relatively small bet here. So I hope that answers your question.
Well, no, we can go in a lot of different directions there. And I just wanted to kind of get your big picture perspective. I mean, from my perspective, I agree with you that momentum is this anomaly. It's there. And sometimes if I look at the streams of returns that come from these different types of investments, they often occur at different times. And I think you could find an argument for many people. I mean, I've seen some people say that there were no investments that did well on the fall of '08. I think some of the momentum style trading did do well at that crisis moment.
Some of them, I think momentum was positive in '08, but it was hugely negative in '09. And that's one thing momentum investors need to be aware of. Their momentum is subject to what are called crashes. When you get these reversals, they just get crushed because the risk regime switches, and all of a sudden, let's say it's '08, early '09, the stocks that did the worst were these small cap growth stocks, and they just were gotten crushed as people fled them. And then when the market turned around, these stocks, they just soared, and you're short them. And you could get literally crushed there. So that's enough. But momentum crashes occur only on the short side, not the long side. So that's another reason I'm a little skeptical and would make only small bets with long-short momentum. But I do favor at least incorporating momentum screens because they avoid the crashes that when you go long-short momentum, that can happen.
Let me bring it back to you the other way, though. So, talking about the disadvantages of momentum, but I would think right now for many investors out there has to be, for those buy and hold investors that have stuck with the plan and they've been richly rewarded on paper in the last few years, buy and hold strategies, obviously performing exceptionally well overall. But we also can look back in the last 15 years and see some rather drastic down spells. So how do you navigate that memory that so many investors have of 2000 to 2002 and the fall of '08 into early '09? How do you navigate that? Because I would think it'd be perfectly logical for investors out there to be thinking, why can't we have another 50% dip?
Well, you certainly can. We've had 3 of them in the last 50 years. And the Japanese, the Nikkei index, was almost at 40,000 25 years ago, and now it's like 16,000. It's still down, at least in price only, well over 50%. And people make the mistake of, that's called the triumph of the optimist, only look at the U.S. data and think, well, stocks can't do poorly for 25 years and still be down. So that's a problem that people make. So the way you navigate is, there's an old saying among generals that battles are won in the preparation stage, not on the battlefield. So investors need to be prepared by knowing their financial history, knowing that stocks can underperform for very long periods, knowing that you shouldn't be subject to this U.S. or home country bias or triumph of the optimist. I always point out to people, 1969 through 2008, 40 years, large cap growth stocks and small cap growth stocks underperformed 20-year treasuries for a 40-year period. And not only have stocks fallen 50% roughly or more, top to bottom, 3 times in the last 42 years or so, but they fell much more than that in the Great Depression, top to bottom, probably, 85% or something like that. And I also point out not only the Japanese example, Michael, but in the early 1900s, 2 of the 10 largest stock exchanges in the world were the Egyptian and the Russian stock exchanges. And those investors are still waiting for return of capital, not return on capital. So you should never make the mistake I call treating the unlikely as impossible. So with that said, what do? Well, you make sure you know your history. Make sure you don't take more risk than what I call the ability, willingness, and need to take. So get the right equity allocation to make sure when the next black swan hits, whether it's a 9/11, an oil embargo, Iran blocking the Strait of Hormuz, or someone shooting off a nuclear weapon, none of us knows what the next black swan will be. You will not be forced to sell either because of economic conditions, you lose your job and you have to put food on the table, or you won't be forced to sell because your stomach's screaming, get me out. So yeah, the only chance I think people have, or the best chance they have of staying the course, is don't take more risk than you have the ability, willingness, or need to take. Then, what's also key, Michael, is most people made the mistake, and you may have made it unintentionally, by talking about it as a buy and hold strategy. It's buy and hold and rebalance whenever your risk tolerance drifts more than you want and are willing to tolerate. So that, for example, you may have started out 60-40, 60% stocks, 40% bonds in 1990, but if you don't rebalance, then by 1999 you might have been 90% stocks and 10% bonds or something like that. I recommend that people use a simple rule of thumb that takes advantage of momentum. It's any 5% drift in the asset allocation on an absolute level or 25% on a relative level, so that if you're 60% stocks, rebalance if it goes to 65 or 55 beyond those ranges. But if you're 10%, allowing that to drift all the way down to 5, that means you've lost half your allocation. I think that's too much, so I would take 25% of the 10 and allow it to drift between 7.5 and 12.5. That's a good rule of thumb. Now, the market has to go up quite a bit before you rebalance. May take a 20%, 25% overall move, and that allows you to benefit from momentum going up. It also doesn't get you buying more unless the market takes a pretty steep drop of roughly 20-25%. But then again, you're then buying, at lower prices and benefiting from momentum. So those are the 2 things that I think are key. Have that well thought out plan. Make sure it's in writing with not only your asset allocation, but rebalancing bands, and then make sure you stay the course. And if you don't write a plan down, the odds of you staying the course are probably close to 0.
You talk about that plan or that process, and I think so many people don't want to, or don't know how to, or just don't even think about it. The idea that process is going to be mission critical, because everyone wants to focus on the outcome. Everybody wants to imagine dreams of sugar plum fairies and equity curves that go straight up and stock markets that go straight up. And that's all about the outcome. And I think what you've been describing the last 5-10 minutes is trying to put together a process that can keep you at least above water when those down spells come.
Yeah, and I think that's key is your plan must anticipate that you will be subject to many crises. In 2008 and early 2009, during the middle of that crisis, I was doing lots of educational seminars for our clients, and one of the talks I gave was, when will things return to normal? And I pointed out that the good news and the bad news was that period, 2008, was normal. It's good news because it's big bear markets like that cause people to believe and understand that stocks are very risky, and that's why we have a big equity risk premium. That's why stocks, on average, have outperformed riskless treasury bills by an annual average of about 8%. If we didn't have those big bad bear markets, then the equity risk premium would be a lot smaller because people would be willing to pay a lot higher prices for stocks. It's those big bear markets that cause that. The second thing I pointed out, that crises happen far more often than people think. And I went back and showed people that the period 1970 through 2008, we had actually experienced 17 pretty severe crises. And I was willing to bet that the audience, typically 50 to 100 people, couldn't name even half of them. And the reason is those crises get resolved typically very often. So a good example, I'll point out, 1994, the sixth largest bank in the U.S. failed. Imagine if that happened in 08 or 09 or today, what we would think would happen to the market. But I'm willing to bet 99% of your listeners can't name the bank. It's Continental Illinois Bank. And I go through these crises and show the people, at the time we thought that they were big events that would kill the market. And yet, the market went up an average of 10% a year since 1970, but we had a crisis literally about once every 2.5 years. So you really need to be prepared, and life's just too short not to enjoy it. So you want to make sure you don't take more risk than your ability, willingness, or need to take and handle. And you should also have what I call a plan B, because we can only even estimate the odds of things happening. So that plan B is, what actions will I take to make sure my plan won't fail if those black swans show up and we end up like Japan for the last 25 years. So it might be to cut back on your goals and be willing to live with a lesser retirement. It might be to plan on working longer. It might be to cut your spending today, whatever it might be. But you want to make sure your plan is there, because you want to make sure you thought out these things when the market is not crashing and you're in the middle of panic and you'll make bad decisions. So that plan B should be written in a period of calm when you're able to make rational decisions.
If we look at portfolio attempts to diversify by owning markets other than stocks, which, everyone knows the best performing market, value, buy and hold, during this bull market, you can't beat it. But, those diversification attempts to try and have something beyond just equities, they're going to underperform during a stretch like this. Or should they be criticized or judged inferior until stocks have had their run? Because we've had in this conversation, we both kind of know, if you're looking at a kind of a decision tree or a scenario analysis, we all know that equities could go the other direction. They don't only have to go in a straight up line. So when you think about those other alternatives that are beyond stocks,
it should always be based on the academic research. And you want to see evidence of persistence and pervasiveness of these things. So number one is, I believe your bond portfolio should be viewed as the risk dampening in the portfolio, driving the risk down to an overall acceptable level. So you should limit your bond holdings to things like treasuries, FDIC insured CDs, annuities that are immediate payout, those kinds of things. And avoid risky bonds, corporate bonds, really, even anything but certainly below investment grade. You want to avoid call risk because that shows up at the wrong time as well. But there are a few things that can help. One, tips, I would certainly consider an alternative investment that can help, but they also come into the category of, say, bonds. Second thing is commodities. They don't hedge all risks. They don't hedge supply shocks. They don't hedge demand shocks like we experienced in '08 when the economy gets hit with a shock to demand. In fact, commodities will tend to do very poorly then. But they do hedge supply shocks like we had in 73-4 when we had an oil embargo, or you could get wars, etc., or periods of political uncertainty. So I think including a broad-based commodity exposure, which also helps hedge unexpected inflation, is worthwhile as well. But almost all the other things I would ignore. And I think the best way to limit the downside risk is covered in my book, Reducing the Risk of Black Swans. It's the way I do it. I have what's called a low beta or relatively low equity portfolio, but the equities are concentrated in the highest expected returning asset class of small value, and it's globally diversified. So it owns U.S. small value, international small value, emerging market value. So that it's sort of a barbell approach because the bonds are all in safe bonds like CDs and U.S. treasuries and the equivalent. So that kind of portfolio has had, over the last 40 years, the same returns as 100% S&P 500, but needing only about 35% of the equity, you got about the same return if you held an average, say, a 5-year bond with much lower risks. The downside risk was a small fraction of the worst case losses that all equity portfolio experienced, but the upside, you kept about half of it. But the average return was about the same.
Larry, you have given my audience good food for thought today. In terms of your writings online, easy for me to find at ETF.com. I don't know if there's a better place to go than that.
Well, now I'm writing pretty much for ETF.com. One other suggestion is people can just set up a Google alert for Larry Swedroe.
And clearly, Amazon.com has a few things that you've done there too as well.
Yeah, I've written 14 books with a 15th just in the final editing stages.
Larry, listen, it was my pleasure to have you on today, and hopefully we can talk again in the future. And let's just keep our fingers crossed and see how exciting things can get in the days and weeks and months and years ahead.
Well, I'll be happy to come back, and just remember the old Chinese curse, may your children live in interesting times.
Thank you, Larry. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.